Imagine your finances like a roller coaster, wild ups and downs. Now imagine sipping coffee while steadily growing your wealth. This video will show you the 10 secrets to turn your finances from a thrill ride into a smooth journey to wealth. Top 10 fundamentals of investing for absolute beginners. Let's go. Number 1. Start early and invest regularly. The earlier you start investing and the more consistent you are, the greater the benefit you'll reap from compound interest. Imagine planting a seed. The sooner you plant it, the more time it has to grow into a mighty tree. Investing is similar. The money you invest today starts earning a return, which is then reinvested and earns even more on top of the original amount. Over time, these returns snowball, significantly increasing your nest egg. Even if you can't invest a large sum initially, don't let that discourage you. The key is to develop a habit of regular investing. Think of it like watering your growing seed every day. Even small contributions made consistently can add up dramatically over the long term. Number 2. Understand your goals. Understanding your investment goals is a cornerstone of successful investing. It's akin to setting a destination before starting a journey. For an absolute beginner, this means taking the time to reflect on what you want to achieve with your investments. Are you looking to grow wealth for a comfortable retirement, save for a down payment on a house, or fund a child's education? Each goal requires a different investment approach, timeline, and risk tolerance. Setting clear, measurable, and achievable goals can help guide your investment decisions and keep you focused on the long-term objectives rather than getting sidetracked by short-term market fluctuations. Once your goals are established, they serve as a roadmap for your investment strategy. For instance, if you're saving for retirement 30 years down the line, you might opt for a more aggressive portfolio with a higher allocation to stocks, which have historically provided higher returns over the long term. Number 3. Emergency fund. An emergency fund is an essential buffer for life's unexpected financial surprises. For beginners in the world of investing, it's crucial to establish this safety net before allocating funds to investment opportunities. An emergency fund is a readily accessible source of assets designed to cover unforeseen expenses such as medical emergencies, car repairs, or sudden job loss. The primary purpose of this fund is to ensure financial stability and avoid the need to withdraw from long-term investments, which may come with penalties or losses if the market is down. Typically, it's recommended to have enough in the emergency fund to cover 3 to 6 months' worth of living expenses. Number 4. Diversify. Diversification is a key principle in investing, often encapsulated in the adage, "Don't put all your eggs in one basket." For beginners, this means spreading investments across various asset classes such as stocks, bonds, real estate, and commodities. The rationale behind diversification is to reduce the risk of significant losses. Different asset classes often react differently to the same economic event. When one class may be performing poorly, another might be doing well. By diversifying, an investor can mitigate the impact of poor performance in any single investment. It's also important to diversify within asset classes, owning a variety of stocks from different industries, for example, rather than concentrating on a single sector. Number 5. Risk tolerance. Risk tolerance is an investor's ability to endure market volatility and the potential to lose money. For a beginner, understanding your risk tolerance is crucial because it influences every investment decision you make. It's a personal assessment that balances your financial situation, investment objectives, and emotional comfort level. Some investors are risk-averse, preferring to avoid losses even if it means missing out on higher returns. Others are risk-takers, willing to accept the possibility of losses for the chance of greater rewards. Knowing where you stand on this spectrum helps you choose investments that align with your comfort level, ensuring that you can stick to your investment plan even when markets are turbulent. Number 6. Research. Research is a fundamental step in the investment process, especially for beginners. It involves gathering and analyzing information about potential investments to make informed decisions. This can include studying market trends, understanding financial statements, evaluating company performance, and staying updated on economic indicators. For individual stocks, it means looking into the company's earnings, debt levels, management quality, and competitive advantages. For mutual funds or ETFs, it involves examining the fund's objectives, performance history, fees, and the expertise of the fund manager. Number 7. Invest regularly. Investing regularly is a powerful strategy for building wealth, often referred to as dollar cost averaging. This approach involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. For beginners, this can mean setting aside a portion of their income monthly or quarterly to invest in a diversified portfolio. The advantage of this method is that it helps reduce the impact of volatility on the overall purchase price of investments, as more shares are bought when prices are low and fewer when prices are high. It also instills financial discipline, making investing a habit rather than a one-time event, and can lead to significant growth over time as the investments compound. Number 8. Long-term perspective. Adopting a long-term perspective is fundamental to investing, particularly for beginners who might be more susceptible to the emotional roller coaster of short-term market fluctuations. This approach encourages investors to focus on the end goal, whether it's retirement, education, or another long-term objective, and not to be swayed by temporary dips or spikes in the market. It's about understanding that while markets can be volatile in the short term, historically, they have trended upwards over the long term. Patience and perseverance are virtues in the investment world, and those who can weather the storms without panic selling or irrational buying often see the greatest returns on their investments. It's a reminder that time in the market typically trumps timing the market, and a steady, committed approach can yield fruitful results. Number 9. Low-cost index funds. Low-cost index funds are often recommended for beginners as a gateway into investing due to their inherent diversification and cost efficiency. These funds track a market index, such as the S&P 500, and aim to replicate its performance. By investing in an index fund, a beginner gains exposure to a wide range of securities within a single investment, which can help mitigate risk. Additionally, index funds typically have lower expense ratios compared to actively managed funds, meaning more of your money stays invested and compounds over time. This passive investment strategy is favored for its simplicity and has been shown to outperform many active investment strategies over the long term. For those starting out, it's a practical way to participate in the financial markets without researching individual stocks or time the market extensively. Number 10. Review and adjust. Reviewing and adjusting your investment portfolio is an ongoing process that is crucial in achieving your financial goals. As an investor, especially a beginner, it's important to periodically assess your portfolio to ensure it remains aligned with your objectives, risk tolerance, and the changing market conditions. This might involve rebalancing to maintain your desired asset allocation, taking advantage of tax loss harvesting, or shifting strategies as you approach milestones like retirement. Life events such as marriage, the birth of a child, or a career change can also necessitate reviewing your investment approach. If you're feeling fired up to learn more, hit that subscribe button for more investing content. And remember, leave a comment below and let me know what other investing topics you'd like to see covered.